So there's been some really big developments in the stock market, both good and both bad for the trade war and what's going on with the whole economy. So we're going to go through 6 of my favorite charts right now to break down the true state of the economy, the true state of the stock market, and where I think we're going to go. The 2 things that I'm going to show you at the end, these are good news things that just came out with regards to the tariffs, and if they actually go through, which I think they will go through, the stock market should go through the roof. So this is a raw breakdown of these charts right here, and chart number 1 is going to be the forward PE ratio for the S&P 500. So the blue line right here corresponds to the S&P 500 PE ratio, and the gray lines right here correspond to when there's recessions. So one thing to note just real quick about recessions, typically the price part of the price earnings ratio, so the price of the stocks fall a lot, and the earnings don't usually fall as much. Usually it's an overblown correction down. So what that means is typically in a recession, PE ratios go way down. So you could see just a few months ago, we were up here in the 23 range on a PE ratio for the S&P 500, and right now, as of April 4th, we're at 18.4. So we corrected down quite a bit right here on the PE ratio because everybody's freaking out about tariffs, or recession, what the economy is going to actually do. So people are selling stocks like crazy. Now, as the market falls, as things get cheaper, they are getting safer in price. But I will say this, up here at a 23 PE ratio on the S&P 500, that is very, very lofty. So yes, we went from a very lofty level up here to a level right here that's closer to intrinsic value, but I'm not saying that right now there's some extreme deals out there right now. I just think things are close to intrinsic value, but it's by no means a massive sale. So yeah, right now we're down 20% from peak to trough roughly, but I feel like that dip is 100% justified whether we had a recession or a trade war or all this tariff stuff or not. So the point that I'm trying to get at by looking at chart number 1 is yes, things are cheaper and yes, things are a little bit safer at this level right here versus up here, but understand that the market could keep falling lower and it could go to an even lower PE ratio. Now, I talk about it a lot on this channel that interest rates are like gravity on the stock market. So notice right here in 1980, this chart shows you what the federal funds interest rate was, and you can see that it's been on this downward path all the way to current. Yes, we have this locally high level right here, but we are ticking down a little bit. And as inflation falls, which I do think inflation will fall in a bumpy way over time, this will continue to trend down. But the key to understand from these 2 charts together, because they work really well together, is this. Overall, you could see interest rates are going down from 1980 to current, but if we go from 1980 to current right here, you could see that PE ratios are trending up, and this is what typically happens. As interest rates fall, PE ratios go up, because when interest rates are up here in this 20% range right here, you could go get a 20% bond at a risk-free rate of return. So if you could get a guaranteed 20% in a bond or a risky rate of return in the stock market, stocks are going to be trading at a very low PE ratio right here because stocks are not going to be a compelling investment. You're not going to want to get a risky 10 when you could get a guaranteed 20% return in a bond. So this is a dynamic right here that you have to keep in mind. And the reason why these 2 charts matter is because PE ratio is one of the best single metrics to really understand the valuation of the stock market level. Now, when you understand interest rates and how inflation's actually going, which inflation's right here on this chart, you will understand that inflation's coming down, but in a bumpy way around this 2% level. But if you expect inflation to keep falling, one could assume that interest rates are going to fall too, and if interest rates fall, this PE ratio might go up. So the point I'm trying to get at is this is kind of loading up the stock market to potentially have a pretty big rebound rate here, especially if inflation continues to trend closer to this 2% level right here. And I will say this, Jerome Powell at the Federal Reserve, he is in a very tricky position right now because these tariffs are going to go into place, which is probably going to raise the price of goods. When the price of goods go up, typically you want to raise interest rates to try to bring cost of goods down. But when you have a slower economy like we have right now, you'll typically want to cut interest rates to try to support the economy and get people to go buy stuff because it's going to be cheaper. But you can't do that because if you cut interest rates, yes, you're going to help the economy, but you're going to make inflation go up. And if you raise interest rates to try to bring inflation down, you're just going to hurt the economy because you're going to make the cost of capital go up. Your car payment's going to go up, interest rates are going to go up on really anything that you buy, your car, your credit card, your home, whatever it may be. So the Fed is in a very, very tricky position right now, and this is what everyone's talking about with stagflation. And I will say this, I was just listening to Jerome Powell at his most recent meeting, and I don't think many people picked up on this. He was asked about this dynamic of stagflation and what he would do with interest rates to try to combat one or the other, and he basically said this. Higher inflation is going to be transitory and it's going to be a one-time thing from tariffs. So he was basically implying that we're not going to make a lot of inflation progress for 2025. So what he's basically saying is this, we're going to cut interest rates even though inflation is still going up because we feel like this inflation bump from tariffs is a one-time thing. So we're going to focus on keeping the economy strong, and inflation is going to just trend down in the next couple years. So I think this is very, very bullish for the stock market, and I don't think many people are thinking about this either. Now, chart number 4 is a really big one that I also feel like is bullish for the stock market, and I just want to be crystal clear with everything I'm talking about right here. I am by no means calling a stock market bottom, but I do think that the stock market, the more that it falls, the more compelling that it's eventually going to get. There will be a price where everything becomes attractive again. You're going to see Warren Buffett buying stuff. All these famous investors are going to start buying stuff. And as we fall, I am slowly deploying capital on the dip. But I am by no means betting the entire house, betting everything on call options, expecting the market to just do a V-shaped recovery like COVID and stuff like that. So be very careful out there right now. So this chart right here is very, very, very important. I know that Warren Buffett looks at this too. And it's basically telling you if you put your money in a bond versus a stock market, how much more money are you going to get paid on an annual basis if you go in the stock market versus a bond? So you can see right here, this line is going up. As this line goes up, stocks are becoming more attractive because bond yields are going down, so you're going to get less yield on a bond. And stock prices are falling too, which means that they're cheaper. When stock prices are cheaper and bond yields are falling, stocks become attractive on a double whammy basis right there. So I like that. But understand this, we were all the way down here to 3, so meaning that stocks were only 3% more per year on average versus the bond. So it was very unattractive to buy a stock versus a bond. Now, as we're getting close to this 5% level right here, stocks are becoming a little bit more attractive, but they are by no means 100% buy right now, because look over here in 2011, things were a big buy over here because you're essentially going to get 10% more in the stock market versus on a bond, but down here we're not even at 5 yet. And I get it that this chart is from March, so it's a few days laggy, so I do expect we're a little bit above 5 right now. So understand, yes, that things are becoming more attractive, but we're definitely not going to want to bet the entire house on it right now. And I bring this chart up right here because everybody knows Warren Buffett's most famous quote, to be greedy when everybody is fearful. So this is a consumer sentiment index, and you can see we're all the way at rock bottom right here. And this goes all the way back to 1980. And I mean, we've only seen levels like this just a couple times to what we're at right now. So right now we're at rock bottom on consumer sentiment, and this is one of the best times to buy when everybody's freaking out in the market, when no one could really see the light at the end of the tunnel. I promise you, America has been through so many bad things in the last 50, 100 years. We've been through world wars, we've been through pandemics, we've been through 9/11, we've been through the 2008 financial crisis, we've been through 1929. I mean, we've been through a lot of crazy stuff that nobody thought we were ever going to come out of, but we came out of it every time, and we came out stronger every single time. Yes, Trump is doing some crazy stuff right now with tariffs. Yes, some of the stuff I agree with, some of the stuff I don't agree with, but I do think overall it's going to be some sort of negotiation, and we're going to meet up in the middle with these other countries, and America is going to come out stronger and better at the end of the day. And if we don't, I do think that Trump is going to get hammered at midterm elections, and of course when the presidency comes up, and I think the Democrats are probably going to just sweep everything. And when Democrats sweep everything, if they do, they're just going to cancel all the tariffs, and America will be back in 4 years. And of course, 4 years is a long way down the road, and nobody really knows exactly what's going to happen with Trump and what he's going to do on these tariffs. But I am optimistic that we will come to an agreement, we will come to a negotiation with these countries, and it will eventually work out in the long run. So some news that did recently drop that's very, very bullish for the market, and I just posted this on Twitter, so if you don't follow me, link below. I post all these real-time updates all the time. Vietnam offers to remove all tariffs on U.S. imports to avoid Trump's tariffs. India is actively negotiating. Singapore says they're not going to retaliate. This is all very good news for the stock market, but the whale in the room is, of course, China. We do so much trading with China. They're our number one partner. If we could come to a deal with them, the stock market will absolutely go straight up. And I am optimistic that over the course of the next few months and the next few quarters, we will make a deal with China. We will meet in the middle, and everything will be okay. Nothing is guaranteed, and there might be a lot more pain in the stock market to come. But the fact that these countries over here, just after a few days of Trump announcing Liberation Day, they're already trying to negotiate with us, I think that this is very good. Now, there's one more country that we're actively negotiating with, and they did just bend a knee, and this is massive for tech and AI and all the chip stuff. This country is going to change everything if we could really make a deal with them. Let's take a look. And the two big dog companies that this is good for is TSM and NVIDIA. Everybody knows who NVIDIA is, but TSM makes all of NVIDIA's chips. Guess where they make this from? Taiwan. So Taiwan on the top right here, I said that Taiwan will not retaliate against Trump's 32% tariffs. The president of Taiwan proposed a zero tariff framework to guide trade talks with the United States. Taiwan will not raise trade barriers and instead will aim to strengthen ties. The country will continue the United States investment of $100 billion of TSM in Arizona, and Taiwan is also reviewing major U.S. product purchases and working to eliminate long-standing non-tariff barriers. This could be very good for NVIDIA. This could be very good for TSM because think about it. NVIDIA just designs their chips. They don't actually make their chips. TSM makes the chips. So if we have no tariffs on TSM, we have no tariffs on Taiwan, NVIDIA could be in this whole closed loop cycle of no tariffs really affecting them. That could be very, very, very bullish for the stock. So as NVIDIA falls, I'm adding exposure to it because I believe in NVIDIA in the long term. I'm not saying I'm YOLOing call options right now, but the more that it falls, the more risk that I add to it. So at the end of the day, of course, nobody likes to see their portfolios go down, but this is just a part of the process of investing for the long term. The stock market's a roller coaster. There's a lot of good things, a lot of bad things that happen. As the market dips, you should buy more. As the market gets more expensive, you should buy less. And if you understand how to value the market, you'll know when to do that stuff. When a market's cheap, I buy calls and I sell puts. When a market's expensive, I buy puts and I sell calls. It's a very simplified process that I designed. If you want to learn how to do it, click the link below to do my course. But if you don't want to do my course, watch this video right here. It's how I do stock options on a very basic level. I'll see you guys there.